Business of Property podcast. I'm Simon.
And I'm Simon.
I've been investing in property for over 20 years, and if you're an active landlord or planning your next property investment, this podcast is for you. Simon Glastonbury, the guest today, is an independent mortgage broker with 25 years of experience providing mortgages, bridging and development finance for home buyers and investors. So today, the topic of conversation is, of course, mortgages. And before we talk about the obvious around base rates and the Bank of England decisions and what's happening in the market, when I first joined this call with Simon today, pretty much the first thing he told me is that he's really busy. And he's not the only mortgage broker I've spoken to in the last couple of weeks who has said they're really busy. So my first question, Simon, is why are you now really busy?
Hi again, Simon. Yes, great question to start with, and it's good news. It's good news from the mortgage broking world. It's been a while, I must say. It's been a long time coming, it feels. But I think the main reason, people getting used to rates, quite simply. The rates have now been around. We're starting to see a very slight drop in rates. It's nothing exciting, but people are getting used to the fact that if you're in the residential market, you're going to be paying. If you're lucky, you're going to, depending on your equity in your property, you're going to be paying very, very slightly, just under 4%. The likelihood is you're going to be paying somewhere around 4.25%. But people are getting used to that now, I think, and with possibly the expectation of rates falling over the next 6 months, a year, which we will go on to, I just think people are getting comfortable with it within the marketplace. We're definitely seeing movement. We're seeing more properties on the market, both and certainly from an investor point of view, we've got a lot more as a team. There's 8 of us within the team here, so we're constantly talking what's coming in, what inquiries are you getting, and the investor buy-to-let market is definitely picking up. So you have your portfolio landlords looking around again, and we can only expect that it's that comfort factor. Right, okay, they're working it in that they're now working on rates of, in the buy-to-let market, 5%. Can I factor this in? Is it going to work? Is the cash flow, the yield, etc., is that going to work for me over the longer term? And I think it's just getting your head around that. I don't think there's anything. It's not like there's a glut of property on the market which is particularly good. I still think that will come, but I really won't. I'm very positive about the end of the year. I don't think it's a spike. I think it's something we're starting to move. I think we're all the same. We're in a society where if you're looking at a residential property, you want to move. We've had that. Mm-hmm. We're in a society that I don't think we're moving every 5 years. It'd be interesting to see the stats on it as we used to. That's certainly been delayed with COVID, with rate increases, with just how we are. So I think there's been a bottleneck there. But because of that, there's this sort of this sort of will for everybody to think, right, okay, I've got to move now. I've done it. Even with we're noticing even with people who've done extensions or done a lot of redecoration in COVID or after COVID, they're going, well, I've done that, but I still want to move. So because we just have that within us. So with that, and then also with it, you flip that for investment side, people are then looking for a new investment because they've got that itch. You have it. We're in the market. This is what we talk about. This is what we deal with. So people want to do that. Right, I want to buy something else. They have the money. Where else am I going to put it? So they know it, no market. So I think that's the way forward. And as a team, we're all the same.
Yeah, I find it sort of slightly counterintuitive that it's happening now, because the market has for a while been saying base rate's going to be dropping soon, honest, and then it did just start to drop, and then there were sort of hints that this was just the start, and it will carry on dropping now, and that to me sort of says, well, hang on, I should surely wait 6 months until it has dropped some more, and that would be the time to be getting a mortgage, not now, when while it has just started that little drop, rates are actually still quite high. So I'm not sure I understand the logic, but I think what you suggest there is that actually people want to move, they want to be deploying their capital if they're investing or whatever it is, and really they just needed a little push, and
Yeah.
that little base rate dip that we saw now nearly a couple of months ago, was perhaps just that little push. So
Yeah.
maybe it's not really the completely sound logical decision, but actually people aren't very logical, and they just needed a little push, and then their emotions have taken them the rest of the way.
Absolutely, I'm with you all the way. It kind of, you've hit the nail on the head. Absolutely. If you think there's a lot of indication that there's going to be another 0.25% drop by the end of the year, we talked in the last pod that we were looking at potentially there's a 0.5% at some point in 2025. So you and I would then say, well, let's hold fire. Well, people are not actually, don't think like that. You often, rule with your heart rather than your head. And if people if people haven't, certainly from an investor point of view, if you haven't bought anything over the last few years, and you're used to buying, and you see that there's, equally it goes with the property. Is it a good deal? Is it a really good property? Is it in a good area? Has it been on the market for a while? Can I get it for a good price? If you can, and you can factor all of that in, you can factor in the rate as well. You think, well, okay, it might come down by 0.25%, 0.5% next year. I'll worry about that. I'll worry about that in a few years' time. I mean, it's slightly different with investors to residential in that all of my residential clients are going on to 2-year products. Not, it's a complete switch from where we were not that long ago. Investors are different because they're going on to 5-year products, probably, as you know, because generally lenders will lend more on that basis. Yeah. So their hand is forced that they've got to go down that route, which is a bit of a shame. But they're still looking at 2-year. Every single person, because the expectation is everybody knows it, or everybody thinks it, that rates will come down. So, but it's that inquiries. Yes, we're we're busy with applications, but we're also very, very busy with inquiries. But those inquiries may not happen until the new year, spring next year. And by that time, we may have a better indication of what's happened with rates. Rates may have dropped a little bit. But I think overall, people are now realizing that rates are not coming back down to 1%, 1.5%. So we're kind of where we are. And you made a point there is rates are high. Rates are high in comparison to what they were a few years ago, but historically they're still in a good place. We're still borrowing at 4.5%. It's a good place to be, and when people have got their head around it, yes, I think we will certainly. I think 2025 for the marketplace is going to be very, very good. It's the first time I've been confident about it for years, because we've just got that the indication of where we're going to go. Hopefully, it's not a spike. I'm hoping that anyway.
Yeah, let's hope so. So, talking then a little bit about where rates are going. You've talked already a bit about what you think base rate might do over the next 6 months and then next year. And of course, a couple of months ago-ish, we saw that first little 0.25% drop. And then the most recent meeting with the Bank of England, they held rates. So how has that all sort of trickled through into the actual mortgage rates that people are achieving on mortgage products? Has that been sort of dropping, or is it? Well, you tell me. How is it going?
It has. We were talking before we came on and saying that nothing exciting is happening. That's for sure. Without a doubt, lenders before the base rate increases, put their rates up without telling anybody. I'm talking generally here, and then so they can then come out with this big hurrah to say we've dropped everything. I mean, we're seeing it everywhere at the moment. You can't help yourself but falling over the next lender coming out and saying, look, we've got market leading, we've dropped to here. And the underlining factor is that, I mean, we're talking between February of this year when we were looking at rates and we were talking about it, and now, generally speaking, rates across the board have dropped 0.2.
Which is not really anywhere near as exciting as the headlines would lead you to believe.
No. If you believed everything these lenders were saying, it's they're a percent down of where they were previously. It's just not happening. Yes, but again, as we were saying, if you have a portfolio of property and you took 0.2 off of every rate, you'd be very, very happy. That's it. It is a margin, and you don't want to be paying the higher rate. But there isn't anything exciting happening, particularly in the mortgage market at the moment. I think, again, we were waiting for the base rate to drop. I think we're kind of waiting for that to happen again. If we have a 0.5% drop overall within a matter of a few months, that's got to push the lenders to drop rates. That's got to put them down. Residential rates are dipping just below the 4% mark. Investment rates, buy-to-let rates, they are going around about the 4.5% mark. Again, there are so many, we talked about it previously, there are so many different rates around. If you want to pay huge fees, as we've said before, they're still 3.5%. You can get rates, but you've got to pay a 7% fee. But the realistic rates are dipping around the 4.5%. Now, that what's going to happen going forward? That's what everybody's saying. But I think the going back to what we were saying previously, it's giving us an idea. Us as a society, we're going out and expecting, well, this is where we are. This is where we're going to be for the future. I'll take that on board. I'll live with it, and we'll go from there. But I do think the base rate is going to be cut again by the end of the year. I do think it's going to be cut again first half of next year. Whether it's I think 0.5% by mid June, July next year that's a big call. But if it comes down another 0.25%, that's down to 4.5%. I think we'll all be. Yeah. We're in a better place, definitely.
Yep, quite. And as we've discussed already, even without those rates actually coming into play yet, we're seeing the market picking up. We're seeing more people out there looking for properties, finding out their options for properties, and there is more movement, more action.
Absolutely.
And that really is the sort of more critical part, that people are finding ways to make it work.
Absolutely.
In the current situation.
It's interesting. We've had a conversation with someone, or a number of conversations about market, what's happening, how's it stimulated, where are we at the moment? We have and I think the expectation when rates went quite high is that portfolio landlords would start getting rid of their properties which are just not making them any money, which is generally for a portfolio landlord your one bed properties, because yield isn't quite as good when you get the mortgages up there. It does depend, of course, it depends on area, it depends on your portfolio, but from what we're seeing, that is generally the type of property they will get rid of because the capital growth isn't quite so good, they're not quite so in demand. As a landlord, you'd probably prefer a 2-bed to a 1-bed. It just gives you a lot more sort of flexibility. But we haven't seen that happen, as much as we expected. Which then does that then create a problem because there's certainly an issue with first-time buyers. The first-time buyers are not out there, and until first-time buyers come into the marketplace, that then stimulates the market even more because then the chains can follow through. It's quite a simple process. We know that. And of course, if it doesn't anything at the bottom doesn't start happening, the top end is really suffering. That's where it is, because the chain can break down all the way through. And if you're at the top of the chain, it's going to be the hardest property to sell. We're definitely seeing that. The larger sort of you're going to 1 million, 2 million plus properties, they're definitely hanging around. Then there's always one which will sell within a day, and the agents will say, "Oh, I've got a list of buyers for you." Of course you have, but they're still on the marketplace, and no one's looking. So, but we need to do. Now, maybe that will be something for the budget. Maybe something will come out. Maybe Labour will come in and do something wonderful for first-time buyers, because it needs to. They need to stimulate the market. I mean, they came out with a figure the other day about how many billions they've made on stamp duty. Well, that was a surprise, because the property market, or the purchase market, is definitely down. You talk to any estate agent of any worth any sort, they will tell you figures are down. It's a fact. But rates have shot through the roof compared to what we were a few years ago. The market is very, very different now. How do we stimulate that going forward? We've got to get first-time buyers in the marketplace again. That's going to be hopefully down to something announced in the budget. Whether it is or not, who knows? I still think they're going to be gunning for the portfolio landlord, or the buy-to-let investor. Hold on to your seats here for that one, I would say.
Yeah. I mean, that could be bad. I've heard all sorts of crazy scaremongering around that, and I hope most of that's not true.
Let's hope.
But as you say, there's probably going to be something bad in there.
Yeah.
But I doubt it's going to be quite as bad as some of the scarier end of the rumours.
Absolutely, I've heard some awful ones. So I mean, there's going to be. We're kind of expecting it, but let's hope there's also something in there that stimulates the market as well. Because I mean, we know rental market is going up. They're getting more and more expensive. And you sort of see this sort of average figures on rentals now. Good if you're very good if you're a landlord. Don't get me wrong. That's a market we're in. But if you're a renter, not quite so good. They're only going one way. We're talking as a homeowner. You're constantly looking, can I get my mortgage down? Can I get my payments down? It's not going to happen with in the rental market. You're never looking at that unless you knock off a bedroom, unless you go to a smaller property in a lesser area. How many people realistically want to do that? Not very many.
No, quite. And I think there's a lot less, because there are fewer rental properties available at the moment. There's a lot less sort of movement in the rental market, as well as in people moving around. So I suppose that's sort of a chicken and egg thing, really, isn't it? Because there's less people moving, so that's why there's less properties on the market. But anyway, and I think it does mean, though, that more renters are staying still for whatever reason, whether it's the chicken or the egg. But it means that they are just sort of, as you say, stuck with the rental increases that are happening to them a lot of the time. And it's harder for them to, as you say, oh, okay, I'll try and find a cheaper option, because there just aren't any out there.
No, absolutely not. And what do you do? And like I said, do people really want to downsize? Rarely happens. And some people, you just can't. We've got children in schools in and around the area. You can't go too far away. They're working. If you get to that certain age in life where you have children, you have a family, or you're near work or whatever, you're dictated by where you live, and it's just not that easy. So they do that. The rental market is, if you're in that market and you're paying rent, it can be quite difficult, or it can be very difficult, because all you're looking at next year is a potential rent increase. When us mortgage owners or homeowners are looking at, well, hopefully rates coming down, and that's going to cut hundreds of pounds off. Doesn't happen. I'm not repeating myself, but it'll be interesting how that goes, and how the new government attack that in any way. If anything comes in, but we shall see. I'm sure we'll have that conversation the next time we speak.
Indeed, right. So let's change the subject a bit. So I have heard independently from a couple of people recently that they have an HMO property and they are wanting to try and achieve a commercial valuation on their HMO property as part of either their mortgage or their remortgage in order to maximize the valuation that they get and hence maximize the potential mortgage value and capital they can extract from that property. So the first question is, Simon, what is a commercial valuation in this sense on an HMO type property, and how does that differ from a non-commercial valuation?
In very simple terms, the commercial valuation looks at what the property will generate as an income, compared to a standard valuation where what they're looking at is what other properties in the area, what are they generating, and I will assess the valuation in comparison to the property next door or down the road, which you'll see on most of the valuations anybody out there would have seen. There's always comparables at the bottom. This, we're looking to buy a property, let's say circa 250,000. There is a property 4 doors down. That's just sold for 245, so we're happy with that overall valuation, and it was rented out at X. Now, as a commercial valuation, then they're looking at a wider market in looking at it as a commercial entity as such. Right, what can it create? How is that going to be generated, and why? Now, there are two ways of, or sort of two issues with this as such, certainly from a mortgage broking point of view. We said this before we started, saying, right, what is it? How does it work? Very, very few conversations I've had over the last 5 or 10 years of people coming to me saying, oh, can we look at a commercial valuation? Generally, in the conversation with someone looking at absolutely every single penny which was going through their account forensically. So if you're like that and that's the type of thing you like to do, then have a conversation with your broker and say, is it possible? Can I get more money out of my property by looking at a commercial or in investment valuation rather than a short form valuation? Now, the problem you have there, if I'm putting hurdles in the way, number one, which lender are we going to go to? That's the big thing, because most of the what we would then class as mainstream lenders, which you would hope that your portfolio landlord would go to, the likes of Paragon, Kent Reliance, Landbay, TMW, to name but a few. There are other lenders out there. I'm not giving those any particular plugs, but for those, in the majority, they won't consider. Sorry, I say Kent Reliance. Kent Reliance will look at it, but in the majority, they won't look at it. They're not interested in commercial or investment valuations. So first of all, you've got to look at that. Now, that then creates its own problem, thinking, well, is that the best? Are they offering the best rate? Now, if they're offering the best rate and the best, as we've said before, best rate, best fee. Now, just because you can go to a commercial valuation, which in my experiences are more expensive anyway, to actually get in the first place. Now, are you then is it worth getting that extra 5%, 10% in valuation to pay a slightly higher fee, slightly higher rate? I mean, it's something you've definitely got to look in case by case, because I'm talking generally. You're only really going to be looking at this probably on an HMO property or a multi-unit block, because of the how quirky they are, how they're looking at rooms, how they're looking at valuing the overall assessment of the income you're getting in. But even there, I don't come across many HMOs which have an issue with valuation anyway, because because they're based on yield. They're based on quite a high rental. It's not like your standard buy-to-let with a standard AST of £1,000 a month. You're paying by room. So it's always going to be higher. People then generally know, well, I'm not going to get the capital growth on an HMO because generally of where they are, but I will get the yield from it. So it's. I think that's why we don't get a huge amount of inquiries. It's certainly from anybody listening, wanting that and having that, thinking, well, I've heard about this. It's a bit like you saying, oh, I've had this conversation. Why, what is it? Why am I not looking at this? Can I get some more out of a property? I mean, certainly in this, where we are with rates and stress tests, people want to get the loan size up. How can I do that? Can I use an investment or a commercial valuation? Yeah, we can look at it. Most definitely. Chances are it won't go very much past a conversation on the whole. But have the conversation. What I would say to people, if you're stretching, you want to get your valuations up, have the conversation. I think when you start looking at rates and the limited number of lenders you can go to, you've then got to go to that lender, and do you meet that criteria with that particular portfolio? Is another conversation. I think it'd be very interesting what people come out with, and I'm not sure it will. In my experience, not sure there'll be a huge demand for it. There is for the don't get me wrong, for certain properties there may well be in certain areas, but I don't get the inquiries in.
So I think, in summary, probably not as practically useful as the sort of headline appeal might make them sound.
Yeah, absolutely. Yeah, it does. But it's definitely something to have the conversation with a broker with. If it's something there and it's something you're looking to stretch and get as much out of a particular property as you possibly can, have a conversation. It might work. In my experience, I haven't had a great amount of success with it.
Yep. Okay. Fair enough. Right. Okay. So I think that covers that sort of topic. So just to finish up, I'm going to spoil this slightly and say that the rates are not really very different, because we mentioned this earlier on as well. So I think this time around we're just going to say what is sort of an example going rate that you might be looking at. And I think you're probably going to say basically the same as you did last time we recorded, but over to you.
I have absolutely. I mean, we've sort of touched on it a little bit earlier as well, with regard to rates. They have come. I mean, the marketplace lenders have definitely put rates up before base rate started. I'd hang my hat on that. And then they've come out and we said before, everybody's gunning out with their marketing, saying we've dropped rates here, we've dropped rates there. It very, very little. I mean, your standard limited company buy to let at the moment is just below 4.5%. Comes with a 7% fee. Still got to factor that in.
Ouch.
The best rates are still just under 5%. Still comes with a 3% fee. I mean, that's probably, you can live with that depending on loan size. But kind of where we are with the 5-year rates at the moment. Like I said before, if you're an investor, you're still going to be pushed down the 5-year rate, because you're going to be able to they'll lend you more money. It's more secure from a lender point of view. If we haven't touched on that before, that's why they do it. They know how long you're fixed in for. It's a safer bet for them. HMOs, multi-unit blocks, on average, it's about 0.3 above a standard buy-to-let at the moment. So you're looking at around about 4.6, 4.7. Again, 7% fee. At the moment, there's a 6% fee, 6% product with a 0 fee. Could work. Again, does it work on stress testing? HMOs, as we know, as we were just talking about, stress testing is a little bit easier because the rental's so good. But do you want to pay up that? It depends on, you've got to work it out, and that's down to your broker to work out what's best for you over the term. Residential market, that's the most frustrating at the moment, and that there are a lot of marketing out there. We've broken this 4% barrier. Yes, only just by the skin of your teeth. And you've got to meet the criteria. Most of them, you've got to have a 25% deposit, so it's certainly not for your first time buyers. That's there, but they are. I mean, as we were talking, we need the first time buyers to stimulate the market, and they will stimulate both markets, investment and residential, because it just gets things moving. If a landlord is selling off property to a first time buyer, the chances are they're going to buy into another one. We see that all the time. It's just how generally we work. So we need that. So rates, unfortunately, they're not very exciting. Let's hope base rate drops again, and then we are hopefully well and truly in the residential market in the 3% sort of category. And for realistic rates in the buy-to-let market, they will be firmly in the mid fours, with a decent fee, because of course, we've mentioned it time and time again. That's where it can get very, very expensive, because they're all on interest only, or most in a buy-to-let mortgage are on interest only, and you're adding 7% to the capital. It's a lot of money.
Yep. And the resulting calculations from that are not straightforward. So if you're out there listening and you would like some help working out how to compare the rate versus the fee versus the rate you're paying on the fee and everything else that's involved, then please do check the show notes, and there will be contact details for Simon in there, and you can get in touch with him, and he will be very happy to go through all of that with you and work through all those figures and try and advise you on the best way forwards. So thank you very much for joining us again this week, Simon.
Pleasure.
And just leaves for me to say thank you very much for listening, and I will talk to you again next